Good morning, everybody, and I'd like to welcome you to today's webinar, Why Gold, Why Seabridge, and Is It Time to Own Both? I'm Derek McPherson, the Vice President of Research at Red Cloud Securities. Joining me today on the call are Rudy Franck, Chairman and CEO and co-founder of Seabridge, and Jim Anthony, who's also a co-founder of Seabridge, along with being a student of money and is very knowledgeable in the gold space. So today, for the format of this webinar, Mr. Anthony will provide an update on the current state of the gold market. Mr. Franck will provide an update on Seabridge, and then we'll take questions live from the audience. So please send us your questions via the chat, and we'll get to as many as we can in the time allotted. To start the webinar, we'll get the exciting part out of the way first, and then we'll take care of the disclosures. For Seabridge, there may be some forward-looking statements made on this call. I would direct listeners to read page 2 of Seabridge's corporate presentation located on the company's website under the investor section. For Red Cloud Securities, please see the full disclaimer and disclosures on our most recent Seabridge note on our website. I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular needs or situation of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Red Cloud specific disclosures related to Seabridge. A member of the Red Cloud Securities team has visited/viewed the material operations of the issuer. In the last 12 months, Red Cloud has been retained under a service or advisory agreement with Seabridge, and Red Cloud or a member of the Red Cloud team has a long position in shares of Seabridge. With that out of the way, we here at Red Cloud, along with Mr. Anthony, based on what I've seen of his slides, are bullish on gold. And we think we've entered a new longer-term bull market. But I'll leave it to Mr. Anthony to tell you about that, and I'll turn it over to him now.
Okay, thanks. Thanks for the intro. Our thesis is...
Jim, we lost you there, I believe, on your mic.
Yeah, I think we lost. It seems like we've lost Jim on his mic for a second. We'll see if we can get that corrected. Maybe in the interim, Rudy, just pull a bit of an audible here, and we'll jump to your presentation on Seabridge. So we'll get back to the gold market in 1 second when we deal with the technical issues. But with respect to Seabridge, what I would tell you is that it's one of our favorite gold stocks in a rising gold environment, not just because of its main project, KSM, has strong leverage to gold, but there's a number of other fundamental catalysts that we think are going to create shareholder value there. Those things are the expected JV for KSM, and we have a $49 fair value estimate for Seabridge, and that's a lot of it is based on that JV. And then obviously the company's still creating value with the drill bit, with Iskut and Snowstorm exploration projects being active. So with that, I'll turn it over to Mr. Franck, and he'll tell us about Seabridge.
Thanks, Derek. See, we already took care of the forward-looking slide. So why Seabridge? If you look at Seabridge today at the 30,000-foot elevation, lots of reserves. Between KSM and Courageous Lake, we have 45 million ounces of proven and probable gold reserves, plus an additional 10 billion pounds of copper in reserves. And those reserves are contained within an overall resource of 122 million ounces of gold and 46 billion pounds of copper. 2 weeks ago, we celebrated our 20th anniversary since we formed Seabridge in October of 1999. If you look at where we are today, after 20 years, we only have 63 million shares outstanding. And no, we've never done a rollback. Low valuation. Today, we're trading at about $17 per reserve ounce and less than $10 per resource ounce. In mine and Jim's career, we've actually had mines expropriated. Political risk is real. We only focus in North America, mainly Canada and the United States. In addition to low political risk by jurisdiction, we've also taken the KSM project through the environmental permitting process, where the project is now shovel ready for a major to step in and start to advance the project to production. What our team has done best, however, is on the exploration side. We have found more gold over the past 20 years than any other mining company in the world, and that includes Newmont, Goldcorp, Barrick, and others. We also take advantage of market bottoms, doing our acquisitions at the very bottom of the market when assets are cheap, and then taking advantage of market tops and selling non-core assets as a way of funding our core assets. If I could use one slide to tell the story, this would be it. It's a slide that shows our growth in ounces relative to our growth in shares. We believe that we create optionality and leverage to the gold price by growing ounces per share faster than shares outstanding. If you look at our track record over the 20 years, we've delivered on that. At the end of 2018, with 61 million shares outstanding and 122 million ounces of gold in the ground, it meant that every one of our shares was backed by 2 ounces of gold in the ground. And what this has translated to over the past 20 years is probably the best leverage play, the best optionality to the gold price. On average, over the past 20 years, we've outperformed the gold price by about 6 to 1, meaning that every 10% increase in the price of gold over the past 20 years has resulted in a 60% increase in our share price. If you believe that the price of gold is going to go higher from here, which we do, or you just want to have some embedded optionality and leverage to the gold price in case you need to call on that as part of a balanced portfolio, Seabridge has a 20-year track record of delivering that outperformance relative to gold, and we see no reason why that won't continue as we move forward. Our most significant asset is KSM, located in northern British Columbia. It's in the middle of the Golden Triangle, where a lot of activity has gone on over the past several years, and a lot of activity continues. In fact, just to the north of us, 2 majors have now come into the district, with Newmont buying a 50% interest in the Galore Creek project from Nova Gold, and more recently, Newcrest stepping in and buying 70% interest of the Red Chris mine. If you look at KSM, we've now spent about $250 million over the past 13 years, defining today what is the largest undeveloped gold copper project as measured by gold reserves. In addition, we've taken this project through the environmental assessment process, having our approvals both provincially and federally now in hand. And finally, we can project's economics by replacing lower grade material in our current mine plans with higher grade material that we've added over the past few years. One big change for us for the positive has been what's gone on in terms of local infrastructure being built in and around KSM. When we bought this project in the year 2000 from Placer Dome, there were no roads, no power, and no ports. If you fast forward to today, based on other people's money, we now have a major highway just to the east of KSM, Highway 37. Along that highway, the governments of Canada and British Columbia have spent over $700 million extending the power grid. We've now secured through agreements with BC Hydro the ability to buy 250 megawatts of power from this line. We'll be able to buy that power at about 5 cents per kilowatt hour, some of the cheapest power in the world. And last but not least, just to the south of us in the town of Stewart, there's been 2 new port facilities built over the past several years that will provide access into the project to bring supplies in and concentrate out year-round to the Pacific Rim. We're fortunate that KSM is not just a single deposit asset. We actually have 4 deposits that give us about 7.5 billion tons of resources containing 106 million ounces of gold and 46 billion pounds of copper. As we went through the environmental assessment process, we got approved tailings capacity for about 2.3 billion tons of material. So what we've been doing over the past few years is playing around with the mine plans as we add more resources each and every year to focus on the best 2.3 billion tons we have within this large mineral endowment. In 2012, we completed our first pre-feasibility study that was used to get our permits. We did receive the permits in late 2014. In 2016, we updated the mine plans as well as the economics of the project, focusing on the improvements and the commitments we made during the environmental assessment process. And in that updated mine plan, we captured 2.2 billion tons containing 39 million ounces of gold and just over 10 billion pounds of copper. This mine plan gave us more than a 50-year mine life on a mine that would have an all-in cost of a production of about $670 per ounce of gold produced over the 50-year period. What that mine plan did not yet include, however, are the 2 new zones we've now added subsequent to that. We started drilling a new zone in 2014 called Deep Curve. We've now added over 2 billion tons at higher grade material than our reserves. And more recently, we found a new zone underneath our iron cap deposit, where over the past 2 years, we grew that resource to over 2 billion tons as well. In the 2016 pre-feasibility study, we also showed an alternate mine plan capturing the new material we had added up to that point at the Kerr deposit, essentially converting what was more open pit mining into more underground mining, and in the process eliminating 2.4 billion tons of waste rock that no longer has to be mined because of going underground with a large bulk tonnage block cave. That updated mine plan, we essentially replaced about 1 billion tons of lower grade material that were in the reserve mine plan with 1 billion tons of higher grade material, more copper grade than we've seen before. And so that updated mine plan, again, limiting ourselves to the 2.3, 2.4 billion tons that we have permitted in the tailings facility, we were able to still capture 40 million ounces of gold, but instead of 10 billion pounds of copper, we're now capturing close to 17 billion pounds of copper. And as you would expect, that additional copper makes a big positive impact in the project's economics. This project is designed as a large tonnage operation, in fact, to be the largest mine ever built in Canada, with initial capacity designed at 170,000 tons a day. We have a 50-year mine life, where the first 10 years of mine life, the project will produce over 1 million ounces of gold and over 300 million pounds of copper. And if you compare the economics to the original mine plan that constitutes our reserve model to the new mine plan that brings in the Deep Kerr deposit, you'll see that the project economics have improved in every category. Net cash flow is increased by over $10 billion. Net present value is increased by over $3 billion. A meaningful improvement to the internal rate of return. Payback's about the same, but if you look at the operating costs and the total cost has dropped from $670 per ounce of gold produced down to $359, so a drop of over $300 per ounce. And I should point out that these total costs include all of the upfront capital, all of the sustaining capital over the 50-year mine life, all of the reclamation and closure costs, and all of the operating costs net of copper credits. And if you compare this total cost of $360 an ounce compared to what the industry is making gold for today on an all-in sustaining basis, it's less than half of any major in terms of their total cost of ounce. And as good as the project is, we have one more iteration we're working on now. Over the past few years, we found a new high-grade zone with underneath the iron cap deposit. We have over 2 billion tons and a large resource here now. But within that 2 billion tons, we have some very high grade, and we're looking at implementing a 600 to 800 million ton cave, focusing on the high grade zones at iron cap to further improve the project's economics. Because if you look at the project today, and you look at the new zones at iron cap, we essentially can capture 800 million tons at about 0.7 grams per ton gold, which is about 30% higher than our reserve grade, and about 0.4% copper, which is about 33% higher than even the grade we have in the mine plan using Deep Kerr. We expect to have this updated mine model done in the Q1 of 2020 with new economic. We're not a single asset company. We have 3 other projects that we consider core to ourselves. The most advanced is Courageous Lake, a project in the Northwest Territories in Canada. We finished a pre-feasibility study on this project in 2012, defining a reserve of 6.5 million ounces of gold within an overall resource of about 11 million ounces of gold. That study in 2012 was not that robust, and one of the main reasons was at that point in time the Canadian dollar was essentially at par with the US dollar. A strong Canadian dollar is not good for Canadian assets, but if you look at that same mine plan, factoring in today's exchange rate of about 0.75 and today's gold price, you're looking at a project that improves fairly dramatically in terms of economic performance. Above and beyond the gold price and the exchange rate, other areas that we see for improvement are, we have an entire greenstone belt here that's 52 kilometers long. Our existing reserve sits on only 2 kilometers of that greenstone belt, and we have now found 3 new zones along this belt that has the potential to supplement the mine plan on the front end with higher grade material. And then also, the other thing we're looking at Courageous Lake is we believe that within this large project, there is a smaller, more robust project, maybe not capturing 400,000 ounces of gold a year, but somewhere around 200,000 ounces of gold a year that'll require less capital and provide better economics. Unlike the big companies that during the recent bottom were out selling assets to pay for the mistakes at the top of the markets, we took advantage of the downturn and over the past several years did 2 new acquisitions. One of these was a company called Snip Gold that we bought for 700,000 shares. On the front end, we got 2.2 million ounces of gold and about 500 million pounds of copper in the Bronson Slope deposit. But more important than that, we also got another large Porphyry District. Iskut sits only about 30 kilometers away from KSM, very similar in terms of when we acquired KSM, the size of the opportunity then relative to where it grew to today. We see similar opportunities at Iskut. Over the past 3 years now, we've been focusing our activities, trying to find what is the best target to drill first. We now have found a large potential porphyry zone that sits just under the surface that we'll start a large drilling program on in 2020. I think the more interesting acquisition was what we acquired in Nevada in 2017 from Paulson and Company. Paulson and Company had spent about 10 plus years assembling a large land package in northern Nevada, spent over $20 million on the project, came to the realization that they probably didn't have the horses to get this project through to discovery, so they sold it to us for 700,000 shares plus some common share purchase warrants. If you look at the location of Snowstorm relative to some of the biggest mines and more robust mines in Nevada, it's quite amazing that actually this land package was available. Had this land package been in a public company over these years, I'm sure it wouldn't have been available to us, but because it was held privately, we were able to step in and buy it. Our targets at Snowstorm are the Twin Creeks Turquoise Ridge style mineralization. We now have our first drill program underway to confirm that we are in the right rocks with the right alteration patterns around it. This is a project that will probably require multi-years of up to $5 million a year in exploration, but the prize here is phenomenal. And I'll point out that the prize we're looking for is a Turquoise Ridge style deposit. At Turquoise Ridge, they've had over 20 million ounces of discovery since Placer Dome bought that project from Getchell Gold. And still today at Turquoise Ridge, there's 9 million ounces of gold left in reserves at 13 grams per ton. That's what we're looking for at Snowstorm, and we're pretty excited about the early results. So as a shareholder, you might ask, okay, what's going to drive value to me on a go-forward basis? Well, clearly the gold price. As I showed earlier, we provide that exceptional leverage to the gold price. If the gold price is going higher from here, there's no question in our minds that our share price will continue its outperformance relative to the gold stock, relative to the gold price and other gold equities. Exploration success. As I mentioned, our team has found more gold over the past 20 years than any of the majors out there, including Barrick, Newmont, Goldcorp, and others. We have found over 100 million ounces of gold through our own exploration activities at a discovery cost per ounce far less than the industry average. As Derek mentioned early on, I think the best driver of value going forward will be a joint venture at KSM. We admitted very early on that KSM was beyond our capabilities. In fact, we believe there's maybe only 7 companies in the world today that have the technical, the financial, and the social license to build the mine the size of KSM. We continue to dialogue with potential joint venture partners, both from the gold industry side and the copper side. We have turned down at least 5 proposals over the past 5 years. Our view is we only get to do this once, and it's got to be with the right partner with the right terms. Our goal in a joint venture is to try and hold on to upwards of 30% of the interest in the project while minimizing our capital exposure. This is a project that, when up and running at today's metal prices, will generate about $1.5 billion of cash flow a year for the first 10 years of mine life. Hanging on to a meaningful interest in that project while minimizing our capital expenditure is our goal. And we think that once the deal is done, we will see a significant unlocking of value. Last slide, we are dual listed. We are on the New York Stock Exchange with a full listing with a vibrant option market underneath our listing, as well as the Toronto Stock Exchange. We are part of a number of indices, including the GDXJ on New York and the S&P TSX 300 Composite in Canada. Low share count, low fully diluted, only 66 million of shares fully diluted. Good balance sheet, over $20 million in cash on our balance sheet today. And then one last thing to leave you with, this company, after 20 years of existence, insiders own nearly 40% of the stock. You'd be hard pressed to find any company out there with that type of insider ownership that's been around for almost 20 years. And then finally, in addition to the insiders, also good financial institutional ownership, including Sprott, Fidelity, Paulson, and Weiss Asset Management. Derek, that's my last slide. So maybe if Jim is back on, we can go back to the gold market.
Sure. Yeah. That's. Thank you, Mr. Franck. And then I think we will try and throw it back to Jim or Mr. Anthony and talk about the gold market. Mr. Anthony, are you with us?
Yes, I think so.
Perfect. All right. Over to you.
All right. Thanks. Yeah. So here's our thesis on why we think you should be involved in the gold market, buying gold and buying gold stocks. First, the world has far too much debt, about 257 trillion worth, the latest count, being served by an global economy of about $80 trillion, which is way too small to carry that debt. We're in the Hyman-Minsky stage of the debt market, which is to say Ponzi debt, where borrowings are required in order to service the already existing debt. Not a good situation. And, currently, for example, in the US, 12% of GDP goes to interest, which is a significant drain on the economy and one of the reasons why the recovery of the economy since the Great Recession has not been all that robust. And just one estimate out there, about 20% or more of all companies are borrowing to serve their interest, to carry their interest expense. There's a recession coming. We may not know exactly when, and of course there's been a temporary bounce in employment and consumer spending, which has brought hope to the market that maybe there will be no recession, but the key trends are all down. GDP estimates, for example, are falling quarter by quarter. Currently, the GDP Now estimate, for example, from the Atlanta Fed is at 1% real growth for the fourth quarter. The New York Fed's estimate is even lower. Hiring plans are down. Employment growth rates are down. Capital spending is down. Profit margins, corporate profits, all of these key indicators are falling on a trend basis. Of course, they have months where they bounce. But the trend, our view, is down. The Fed will not allow rates to rise, and central banks are therefore going to be extremely, extremely aggressive in the next phase of their monetization, and that's already started. We have 60 billion a month being done now by the Fed, and they say it's not QE. Trust me, it is. I'm happy to answer any questions you might have on that. And so the consequence where we're headed is that currencies are going to fall hard and gold will soar. Now, where are we in the current environment? Well, we're in the middle of a correction, which started in early September. It's driven by sentiment and positioning, and a word, gold is overbought. If you look at the DSI, the HGNSI, they remain elevated compared to where you'd like to be if this was a bottom of the gold price. And in this particular correction, open interest is at new record highs. We need to reduce the speculative overhang, and in fact, recently, last few days, we've been shorting, which is part of the recovery process for gold. We need to do this. However, gold has also been affected by three headwinds. It's not just the overbought situation. We have optimism on the trade front. A trade deal is considered imminent. It's been imminent for a long time, but still there's a lot of optimism about it. That's going to be good for the economy, so maybe you don't need as much gold. A second headwind, there's been a recent backup in interest rates. We maintain this is a bounce, a technical bounce, but the economy clearly cannot sustain higher interest rates. In fact, a 2.5% Treasury rate on the 10-year this time last year was enough to nearly sink the economy. It dried up the bond market on the corporate side and had a lot of issues for companies trying to roll over their high yield debt. So, that's another headwind temporarily. That is the backup in rates, but it won't continue in our view. And finally, of course, the stock market has been stronger, and that has tended to take the focus off gold. But as we've noted, gold can rise with the market in the past. Now, gold also has some major tailwinds. First of all, the Fed is cutting rates, and they will stop at nothing to prevent higher rates. The U.S. economy cannot survive a 2.5% interest rate. And, QE has begun enough to monetize the federal deficit. It's a surprising development, given that 10 months ago the Fed was in tightening mode. So the turnaround in Fed policy tells you that maybe things aren't as good as we'd like to pretend. The fiscal deficit is continuing to grow. We have the threat of impeachment. We have an election coming and the possibility of a Democrat win. All of these things are going to prove in the next few months to be tailwinds for gold. And, that is going to put pressure on the dollar, where we think the primary movement in gold is going to come from over the next year or two. And finally, I would note that we have good underlying demand for gold. ETFs have increased their purchases, and central banks as well. If you look at the latest numbers, the Q3, the ETFs grew by 258 metric tons. That's not inconsiderable. And during the same Q3, central banks purchased 156 tons. Their net purchases to date, 548 tons this year. So all of these issues are in support of gold, and we're at the point we think that this is presenting us with a buying opportunity in the relatively near term, a good time to renew your gold positions and perhaps increase them. Okay, thanks. Back to you.
Thank you, Mr. Anthony. Appreciate that outlook, and makes me feel a little bit better about my day. As the longer term, this being a short-term correction. Perhaps maybe to take the first question on the gold market. You mentioned the not QE, effectively the Fed monetizing the federal deficit. Can you maybe tell us a little bit more about that, and maybe why they're not calling it QE versus what it actually is?
Yeah. So Powell made an interesting argument, Chairman Powell, that this isn't QE because, unlike the QE programs of the past few years, which ended in 2014, this asset purchase program is not designed to bring down long-term interest rates. And so, in other words, buying short-term assets doesn't count. But of course it does. It does add to the Fed balance sheet. It does add to reserves. And in fact, it does help to reduce long-term interest rates because it allows the Treasury to go into the short-term market and finance there rather than forcing more 10-year and longer term securities into the market, which would have an adverse effect on interest rates. So this is one of those things where I think you can use the term it's a difference without a distinction, or a distinction without a difference. You could work it both ways. It doesn't compute that this is not QE. These are asset purchases, and they're at a serious level.
I guess they can call it whatever they want. It has the same effective impact.
A rose by any other name, as they used to say.
Yeah. And then just the second question on gold. Obviously, lately, prior to maybe this slight pullback in September, we've saw some of the sort of the industry titans out there throw out some outlandish numbers on gold, like $5,000 or $10,000 an ounce. One, do you think those numbers are outlandish, and if so, or if not, why?
Well, when you're talking about numbers like that, you're really talking about the dollar, not gold. The only way that the gold gets to play in that kind of price environment is if the dollar is rapidly losing value. So we don't want that. I think no one in the investment community would like to see a rapid and prolonged depreciation in the dollar, but it is the threat that is posed by continuing Fed monetization and the effort to keep interest rates low. So it is a concern.
I guess another reason to own gold. Maybe we'll move on to a couple questions about with respect to Seabridge itself. Obviously, one of the value drivers that we see, and obviously, as you mentioned, Rudy, that you see is the potential JV of KSM. Can you, maybe as much as you're able to, can you give us some color on how those discussions are going and what you I guess what you see coming along those lines?
Well, right now we have more activity in terms of the number of key participants in the data room and talking with us than we've ever had in the past. I mean, clearly this move in the gold price over the past year, going from below 1,300 to 1,550 recently, is positive from the gold company's perspective. It will be helpful to us to see, I think, a rising copper price. Copper at 260 is a tough environment for the copper companies to play in. Also, when you look at some of the funding requirements they have in front of them for their own projects, higher copper price would be helpful. I mean, what I have said publicly is we came very close to getting a deal done last year. And at the end of the day, the potential partners tried to put forward some revised terms to what they had previously agreed, which made it really impossible for us to say yes to. As I mentioned, we only get to do this once. We have the right bodies at the table now that have the technical, financial, and social wherewithal to do this project. And we'll continue to dialogue, but only on the terms that we can live with.
Yeah, I mean, obviously, to get to this point, you're taking a very disciplined approach, and there's no reason to change that. Now, even though you're closer to the end, one of the other things, and you mentioned it, is that you've been a good buyer of assets, a good buyer and seller of sort of non-core assets in the downturn in the market, and that's worked out well for you. Are you, it seems that we're at a point where the gold market's turning. Is this something you're still looking at on additional assets, or are you busy enough with what you guys have sort of in the stable right now?
Well, I think you're always looking in any market environment. There are opportunities at tops and bottoms. We're shown, projects and companies on a pretty regular basis from different banking firms out there, as well as companies that are desperate for capital come to see us because they know that we have the ability to go out and raise capital for good projects. Our challenge, quite honestly, Derek, is finding something that's going to be meaningful. And meaningful, I mean, in terms of size, us bringing in a project that's 1 or 2 million ounces won't move the needle on a company that has over 120 million ounces of total gold resources. But also as a creator. I mean, we really follow the discipline of doing deals on projects where we think we can grow ounces per share. So it has to have a lot of potential on the exploration side for us to step in and buy it.
Right. Yeah, and I think I was lucky enough to visit Snowstorm earlier this year, and that's the kind of project that has that. That's a project that has that kind of potential. A lot of work to do there, but has that kind of potential. And then maybe what do you see as potentially from your perspective? What do you see as the biggest risks and then the biggest opportunities for Seabridge in the current environment?
Well, I think the biggest risk clearly are metal prices. We are fairly positive on gold going forward. Copper, that's something we study a lot. We do believe that the supply and demand fundamentals for copper going forward are very positive for the price, though, in terms of the ability to bring new projects on stream to satisfy perhaps growing demand for the metal. So metal price has always been the biggest risk, and because our company is formed to provide optionality and leverage to metal prices, I mean, clearly in a downward trending market, our stock does not perform well, as you can see on the chart that I showed earlier, but in an upward trending market, we do. And then the other big risk, I think, from our perspective is if you look at KSM, the project has gotten so large that the universe of potential partners is quite small. And you never know what you're competing against within those other organizations for their own use of capital or projects they may already own. So, you know, only having a universe of, say, 7 companies that we believe have the financial, technical, and social ability to take on this project, and then perhaps some of them or all of them at any point in time are not looking at new projects, it makes getting a deal done challenging. I think that's the major reason why we haven't gotten a deal done up to this point, because they've been more inward looking over the past several years, selling non-core assets to try and find a way to pay down debt on debt they took up when they bought assets at the very top of the market and overpaid. I do believe, though, that the elephant in the room, especially on the gold company side, is dwindling reserves. If you look at the industry today, the major gold mining companies back in the 1990s essentially replaced every ounce that they mined through their own exploration activities. The next decade, it was cut in almost half. And then more recently, today, the major gold companies are only replacing about 20% of what they mine every year. And if you look at the reserve life, it's probably about 10 years at best. They need new projects, and they're going to be focusing on new projects in safe jurisdictions that are capital efficient, that can or are permitted, and KSM does check all those boxes.
Well, I think the other thing working for KSM is the fact that the sort of the mega mergers of gold companies has resulted in the project scale required to move the needle for them has gotten so much larger. And KSM is one of the few projects out there that actually can move the needle for some of these guys as well. So I think that's interesting. Actually, interesting this morning, Barrick put out that they were out looking for copper projects. So KSM's a perfect fit for them. And then I guess we'll take one last question here. If we had to look ahead for 2020, obviously you got it's late 2019. Looking ahead to 2020, what do you guys? What should investors be expecting from Seabridge going forward?
Well, I think in Q1 we'll have the updated technical report done at KSM. That'll include the higher grade iron cap zone into the mine plan. We expect to see significant improvements in the project's economics as a result of that, essentially taking 500 million tons plus of lower grade material out of the mine plan and putting in higher grade material. That'll have a positive impact on project's economics. And also iron cap is of the 4 deposits we have, it's the deposit that's closest to planned infrastructure, so that should have help on the capital side as well. Next year, we'll be taking on a large drill program at the Iskut property. We have identified a large potential porphyry zone there that we can reach easily from the surface. So probably we'll have a meaningful program at Iskut. Over the next several months, we'll also be announcing the results of what we learned at Snowstorm this year with our first drill program. We're still drilling there today, and in fact have the last 2 holes in there within the next 2 weeks, and then assays to come. And then hopefully a deal. I mean, our intention, our hope is that we can have a joint venture or a partner in place before the next season begins at KSM, which means that hopefully we can have a partnership completed, during the first, 4 or 5 months of 2020.
And all of that should be helped by the fact that I think we're going to see a record new high gold price next year as well. I'm willing to predict that. Better than 1921, the top in 2011.
That I hope for all of us you are correct on that, because I think that will make everybody a little bit everyone in the mining space at least a little bit happier. I think with that, we'll leave it there on that positive note. I'd like to thank everybody for participating in the webinar today and being on the line, and I'd like to thank Mr. Franck and Mr. Anthony for sharing their sharing with us today. Thank you very much.
Thanks, everyone.
Thank you.